Is your portfolio really diversified? Find out now. Hey everyone, and welcome back to X 100%, where we're all about maximizing your potential, especially when it comes to your finances. I'm your host, Eddie, and today we're talking about something crucial for any investor, whether you're just starting out or you've been at it for years. We're talking about a concept so fundamental it's often summarized by a simple age-old saying, don't put all your eggs in one basket. And today we're going to dive deep into diversification. We'll explore what it really means, why it's so vital, and how to actually implement it in your investment strategy. But instead of just throwing definitions at you, I want to tell you a story about two friends, Sarah and Mark, who took very different approaches to investing. One thrived, the other, well, let's just say he learned a valuable lesson the hard way. By the end of this episode, you'll have a clear understanding of diversification and you'll be equipped with the knowledge to build a resilient, well-balanced portfolio that can weather any market storm. Let's meet Sarah and Mark. They both started investing around the same time with similar amounts of money. Mark, he was a bit of a risk-taker. He loved the thrill of the chase, the potential for huge, quick gains. He heard about this hot new tech stock, Cybernova, and he went all in. Every penny he had, he poured into Cybernova. Sarah, on the other hand, was more cautious. She did her research and she understood the importance of spreading her risk. She invested in a mix of things, some tech stocks, yes, but also some established blue-chip companies, some real estate investment trusts, REITs, and even some bonds. For a while, Mark was flying high. Cybernova's stock price soared. He was bragging to everyone about his genius investing skills. He was making money hand over fist and he felt invincible. He even started talking about quitting his day job. Sarah's portfolio was growing too, but at a much steadier, less dramatic pace. She wasn't seeing the explosive gains Mark was, but she was sleeping soundly at night, knowing she wasn't overly exposed to any single asset. Then, the inevitable happened. The tech bubble burst. Cybernova's stock plummeted. It went from being the hottest thing on the market to practically worthless overnight. Mark lost everything. He was devastated. He had to start all over again, and this time he was much more cautious. Sarah's portfolio took a hit too, of course. The tech stocks she owned lost some value. But because she was diversified, the impact was far less severe. Her investments in other sectors like real estate and bonds actually helped to offset the losses in her tech holdings. She weathered the storm. Her portfolio recovered and she continued to build wealth steadily over time. She learned a valuable lesson about the importance of diversification, but she learned it without experiencing the catastrophic losses that Mark did. This story perfectly illustrates the core principle of diversification. It's not about avoiding risk entirely, it's about managing risk intelligently. So, what is diversification in formal terms? It's a risk management strategy that involves combining a variety of investments within a portfolio. The idea is that by investing in different asset classes, industries, and geographic regions, you reduce your exposure to any single point of failure. Let's break down some key asset classes. 1. Stocks. Equities represent ownership in companies. They offer the potential for high growth but also come with higher risk. 2. Bonds. Fixed income, essentially loans to governments or corporations. They generally offer lower returns than stocks but are considered less risky. 3. Real estate. Investing in physical properties or REITs can provide rental income and potential appreciation. 4. Commodities. Raw materials like gold, oil, and agricultural products can act as a hedge against inflation. 5. Cash and cash equivalents. Highly liquid assets like savings accounts and money market funds provide stability and easy access to funds. 6. Cryptocurrency. A digital or virtual currency that uses cryptography for security. Cryptocurrencies operate independently of a central bank and can offer high potential returns but also come with significant volatility and risk. Examples include Bitcoin, Ethereum, and many others. Within each of these broad categories, there are further levels of diversification. For example, within stocks, you can diversify by industry, technology, healthcare, finance, etc., company size, large cap, mid cap, small cap, and geography, domestic, international, emerging markets. A crucial concept in diversification is correlation. This refers to how different investments move in relation to each other. Ideally, you want to have investments that are negatively correlated or uncorrelated. This means that when one investment goes down, the other tends to go up, or at least doesn't go down as much. For example, stocks and bonds often have a negative correlation. During economic downturns, investors tend to flock to the safety of bonds, driving up their prices while stock prices fall. It's important to understand that diversification doesn't guarantee profits or eliminate risk entirely. It's a way to mitigate risk, to reduce the potential for catastrophic losses. There will still be ups and downs in the market, but a well-diversified portfolio is much more likely to withstand those fluctuations. Think of it like building a house. You wouldn't build a house with only one type of material, would you? You'd use a combination of wood, concrete, steel, and other materials to create a strong, resilient structure. Diversification is the same principle applied to your investments. The first step in diversifying your portfolio is to assess your risk tolerance. This is your ability and willingness to take on risk. Are you comfortable with the possibility of large swings in your portfolio value? Or do you prefer a more conservative approach? Your risk tolerance will depend on factors like your age, investment goals, time horizon, and financial situation. Younger investors with a longer time horizon can generally afford to take on more risk than older investors who are closer to retirement. Once you've assessed your risk tolerance, you can start to choose your asset allocation. This is the mix of different asset classes in your portfolio. A common starting point is the 100 minus your age rule. This suggests that you should subtract your age from 100, and that's the percentage of your portfolio that should be allocated to stocks. The rest would be allocated to bonds or other less risky assets. So, if you're 30 years old, you'd have 70% in stocks and 30% in bonds. This is just a guideline, of course, and you should adjust it based on your individual circumstances. It is important to note that this is a general rule of thumb and is a great place to start, but not a hard and fast rule for every investor. Now, how do you actually diversify? Here are some practical tools and strategies. 1. Mutual funds and ETFs, exchange-traded funds. These are fantastic tools for diversification because they allow you to invest in a basket of different securities with a single purchase. You can find mutual funds and ETFs that track specific indexes like the S&P 500, sectors, or asset classes. This is instant diversification. 2. Index funds, a type of mutual fund or ETF that aims to mirror the performance of a specific market index. They offer broad market exposure and typically have low fees. 3. Target date funds. These funds automatically adjust their asset allocation over time, becoming more conservative as you get closer to your target retirement date. They're a great set-it-and-forget-it option for diversification. 4. Robo-advisors. These online platforms use algorithms to create and manage diversified portfolios based on your risk tolerance and goals. They're a convenient and often low-cost option for hands-off investing. 5. Direct stock investing. With caution. If you choose to invest in individual stocks, make sure you do your research and diversify across different industries and company sizes. Don't put all your money in one or two stocks, no matter how promising they seem. 6. Real estate investment trusts. REITs allow you to invest in real estate without directly owning property. 7. International investing. Don't limit yourself to your home country. Investing in international markets can provide further diversification and potentially higher returns. 8. Rebalancing. Periodically review your portfolio and rebalance it to maintain your desired asset allocation. This involves selling some investments that have performed well and buying others that have underperformed, bringing your portfolio back to its original target mix. Alright, let's recap what we've learned today. We started with the cautionary tale of Mark and the inspiring resilience of Sarah. Their story perfectly illustrated the power of diversification. We then defined diversification as a risk management strategy that involves spreading your investments across different asset classes, industries, and geographic regions. We explored various asset classes from stocks and bonds to real estate and commodities. We talked about the importance of correlation, aiming for investments that don't all move in the same direction at the same time. We also emphasized that diversification isn't a guarantee of profits, but it is a crucial tool for mitigating risk and protecting your portfolio from catastrophic losses. We dove into practical ways to diversify, including using mutual funds, ETFs, index funds, target date funds, and even robo-advisors. And we touched on the importance of assessing your risk tolerance and rebalancing your portfolio regularly. The key takeaways from today's episode are: A. Diversification is essential for managing risk. Don't put all your eggs in one basket. B. Understand your risk tolerance. This will guide your asset allocation decisions. C. Utilize tools like mutual funds and ETFs for easy diversification. D. Rebalance your portfolio regularly. E. Diversification is a long-term strategy. It's about building a resilient portfolio that can weather market ups and downs. So, I challenge you to take a look at your own portfolio. Are you diversified? Are you comfortable with your level of risk? If not, start making changes today. Even small adjustments can make a big difference over time. I'd love to hear from you. What are your favorite diversification strategies? Share your thoughts and questions in the comments below. And if you found this episode helpful, please give it a thumbs up and share it with your friends. The more people who understand the power of diversification, the better. Thanks for tuning in to X100%. I'm Eddie, and I'll see you in the next episode where we'll continue to explore strategies for maximizing your financial potential. Remember, invest wisely, diversify, and stay focused on the long term.